Well, I think that if we analyze the causes of the housing bust, we have to go back a long time. Uh, in fact, actually to the 1980s, when credit began to grow at a faster pace than the economy, and debt to GDP expanded very rapidly. And what we then had is in 1990 an SNL crisis, and basically the system was bailed out at that time. And then we had in 94 the tequila crisis, and again the system was bailed out, largely because at that time Goldman Sachs and some banks and investors held large positions in Mexican bonds. So the Treasury, against the advice and against the will of Congress, bailed out Mexico essentially to protect financial interests. And then we get to 1998 and we have the LTCM crisis. LTCM would have gone bust, but again, LTCM was bailed out by the Fed and the Treasury, and it was again to protect the financial system. And then we come to the late 1990s. We had a housing bubble. We had in the late 1990s a tech bubble, and the head of Y2K, the Fed, was concerned that Y2K would be a problem, so they flooded the system with liquidity. And the Nasdaq, which had been already very elevated in 1997, between August 99 and March 2000 doubled. And then we come to the collapse of the Nasdaq, and the Fed was concerned about the deflationary recession, and as it was the case with the tequila crisis, with LTCM, they again bailed out the system by flooding the system with liquidity and pushing the Fed fund rate down from 6.5% to 1%. And this led again to very rapid credit growth, because essentially financial institutions could borrow money at very low rates. And the problem is with excessive credit growth is that the credit growth can be controlled in theory by a central bank or even the Treasury, but it wasn't paid any attention to by the Fed. They slept under the influence of the Keynesian. They actually encourage credit growth. And when you create credit and when you expand the quantity of money, you know how much you want to expand it, but you don't know where the credit flows will go to. So essentially, in the words of Mr. Bernanke, you drop the dollar bills onto the United States, but he doesn't know where the money will flow to. So it flowed, as I just mentioned, first into Nasdaq in the years 97 to March 2000, and after 2000 it flowed into the housing market. And credit conditions were made easier and easier, and at the same time the Fed encouraged subprime lending. They felt that this was a very good thing, that even people without money could buy homes. And so we have lowering of credit standards in the housing industry, and then came the whole securitization process, and it created a gigantic housing bubble which the Fed couldn't identify, because they felt in 2007 that maybe there would be a slowdown in the rate of appreciation of homes, but they never thought that they would go down. And the people had been brainwashed by economists and the Fed and so forth that home prices in the US had never ever gone down, which is maybe true for the entire United States, but they had gone down very significantly in California after 1990. But that nationwide home prices would go down, that was foreign to the Federal Reserve, with all their economists that went to very prestigious business schools. In any event, this then happened because there was too much credit supporting the housing market and home prices had gone up. to an extent that affordability had diminished. And as I just mentioned, the credit standards were no longer existent. In other words, whereas 10 years ago, someone may have bought a house and paid down 20 or 30%, by 2000, he could refinance his home with essentially no collateral. In fact, there was a lot of fraud where a house had appreciated from $100,000 to $200,000. It was then refinanced with a mortgage of $220,000 or even $300,000. So there was to start with no collateral. There was just the expectation that the house would continue to appreciate. And eventually the housing market came apart because of oversupply and lack of affordability. And then the whole credit bubble that was focused on the housing industry unraveled. The system didn't know for sure that they would always be bailed out. But with the bailout of LTCM and again with the essentially bailout of the economy after 2000 when the Nasdaq sank, the system began to get used to a so-called Greenspan put. And when Mr. Bernanke became Fed chairman in 2006, the saying was, there is a Bernanke put with a higher striking price. In other words, the expectations were that if anything happened to the system, the Fed would come in and flood the system with liquidity, which indeed they did actually after 2008, but it didn't help the housing market. Because as I just mentioned, when you print money and you drop your dollar bills onto the United States, they can flow into Nasdaq stocks, they can flow into the housing market, they can flow into collectibles, they can flow into stocks, they can also flow outside the United States because we have leakages. In other words, you print money in the US, but you boost economic growth rates and inflation in Vietnam, in China, in India, in Brazil, and so forth. So that the Fed does not control. And this is the viciousness of money printing, that it lifts prices, but irregularly. Sometimes inflation will flow into consumer prices, sometimes into asset prices, real estate, equities, bonds, foreign currencies, say the Australian dollar, the Canadian dollar, and so forth and so on. And that has essentially happened. Well, they played a very significant part in distorting the market because these government-sponsored enterprises were able to borrow money at essentially almost the same rate as the government was able to borrow because they were perceived to be guaranteed by the government. In addition to that, they were very badly run because they were government institutions basically, and also highly corrupt institutions. And so they abused the system actually more than anyone else. And of course, when the housing market went down, with their leverage, which was even higher than the leverage in banks and in brokerage firms, they went essentially bust, and the taxpayers had to bail them out. No, I don't think that the adjustable rate mortgages had any impact on the crisis because they came into fashion after interest rates had already gone up. The Fed fund rate had bottomed out in June 2004, and the really a big wave of adjustable mortgage rates came in 2005, 2006, when rates were already high. And actually, the adjustable mortgage rates, they were at the time lower than, say, a fixed 30-year mortgage. And they were actually encouraged by people like Mr. Greenspan, who argued that, yes, if you could borrow at a lower rate, you should do that. The problem with adjustable mortgage rates is that obviously if in future interest rates should go up substantially, then this could become a problem. But that problem also exists for the entire treasury bond market, the treasury note market, treasury bills, for all the countries, Western countries in the world. If interest rates go up substantially, they will have a very big problem, because then the interest payments on the government debts that have exploded in recent years will become extremely burdensome. I think the problem with securitization is the following. If I go, say I live in Atlanta, and then I go to a local bank and borrow money from the bank, you have a bank manager, the employee will come and check the house and see the value of the house, and he will give you a mortgage based on your family and your income and the value of the house. By the way, in America, mortgages are non-recourse. In other words, only the house serves as a collateral for the mortgage. In other societies, you are liable for the mortgage with all your assets, not just the house. And that breeds a more conservative culture among the buyers of homes. So this is something that the US should consider, to make people more responsible on a personal level than just having the house as a collateral for the mortgage. The securitization process, the problem with it is that the lenders of or the buyers of mortgages, they have no clue of the house that serves as a collateral. And what happened is that they were packaged into mortgage-backed securities with thousands of homes serving as a collateral, and then they were leveraged up. And that led to, as I mentioned, essentially an increase in risk-taking, increase in leverage, and that was certainly part of the problem when the housing bubble burst. Mr. Greenspan and Mr. Bernanke both had no clue and never paid any attention to excessive credit growth, which led to overconsumption in the US and to a more vulnerable system, because it doesn't take an economist with a lot of academic credentials to see. You have two corporations. My company has no debts, and my friend's company leverage is up, all the income is spent, and for further expansion they borrow money. So over time my friend's company becomes very leveraged, whereas my company has no debts. Then comes a business downturn. Which company is more likely to go bust? Mine with no debts, or my friend's company with a very high level of debt compared to the equity? In a downturn, he's going to be toast. And the same applies to an economic system. I don't know what the ideal level of debt is for an economic system, but very clearly in the years 2000 to 2007, the economy expanded by $4.2 trillion, and total credit expanded by $21.3 trillion. In other words, credit expanded at 5 times the rate of nominal GDP. Clearly not sustainable in the long run. And the entire problem of the Western world is that by increasing the debt to GDP between 1980 and 2007, and in some countries it has actually continued to increase debt to GDP. They borrowed growth from the future, from future generation, from future years. So as the system becomes more leveraged, you can overspend, but you become more vulnerable. And so that is really the problem of Mr. Greenspan and Mr. Bernanke. And when the crisis erupted, especially Mr. Bernanke, who was by then Fed chairman, he thought that the housing market would maybe decline somewhat, but that the crisis in subprime lending, because there were a few subprime lenders at that time that got into difficulties, that it was well contained. That is the problem. And Mr. Greenspan and Mr. Bernanke, they always maintained, oh, we don't know how to identify bubbles, but if a bubble bursts, we can take extraordinary measures like flooding the system with liquidity. So they never paid any attention to excessive credit growth. Well, that is a view that, where economists disagree significantly. Personally, I think if we go back and think about a bank, you get your salary paid into a bank and you write check on your essentially savings, you withdraw savings and so forth. So a bank has to some extent a social function. You deposit money with the bank and you hope that the bank will repay you that money. In other words, there is a fiduciary duty of a bank. And a bank should be a store of value. But partly because of the removal of Glass-Steagall, banks became more and more leveraged, and banks used more and more capital of the depositors to actually speculate. So the leverage of banks in the last 20 years increased dramatically, partly also because of the bailouts I just mentioned of LTCM, and before that of the tequila crisis of Mexico, and because of the bailout of the system after the NASDAQ broke down. And so again and again, the leverage of banks became larger. There was also another element. When I started to work in 1970 on Wall Street, there was only one investment bank that was a corporation. That was First Boston. All the other investment banks were partnerships. In other words, if at that time Lehman took a large position and the position went wrong, all the partners were liable for the liabilities of the firm should it go bankrupt with their entire assets. And so that bred a culture of relative cautiousness. But as time went by and more brokerage companies became public companies, they started not to play around and speculate with their own money, but with other people's money. And that also applied to the banks. Originally, say, a lot of banks were privately held or the majority was held by a family. But gradually, the system was replaced with managers. The managers of banks, the managing directors, or so-called chief executive officers, the only stake they had in the bank basically were options on the shares of the bank shares. By taking huge risks, if the bank shares went up, they made a lot of money. And if the banks would go bust, they wouldn't lose their own money because they had, aside from the option compensation, very large salaries. And if they got sacked, they would receive very substantial funds for essentially being dismissed. So there was no downside risk to take risk. This is a bit different. The hedge funds have been frequently accused of doing this and doing that and so forth. But the hedge fund managers usually have most of their own money in the hedge fund, and that's why they have much tighter risk controls. It's very seldom that their hedge fund really goes bust, because the partners have their own money on the line. I don't think they should be more regulated, but I think that if a financial institution goes bust, it should be let go bust, because that's the principle of capitalism. In other words, in a capitalistic system, you reward the prudent investor, the prudent businessman, companies that perform well in terms of management, in terms of skills and so forth, and you punish the ones that perform poorly or the ones that are imprudent. If you don't do that, you go into a system of socialism where everybody is always protected by the state, and that is then very negative for economic growth. That I don't know. You would have to ask Treasury officials and so forth. I mean, Drexel Burnham, I was working at that time at Drexel Burnham, and when they went bust in February of 1990, and at that time, people on Wall Street and in governments and the establishment simply didn't like Drexel. So they were quite happy that it went bust. In the case of Lehman, there may have been an element of jealousy among other people on Wall Street, and they were maybe quite happy to see it go bust. But Lehman going bust was just a symptom of extensive rot in the financial system. It didn't cause the financial crisis. The financial excesses, the excessive leverage, caused essentially the demise of Lehman. Well, I think in the US and also elsewhere, the entire banking system was bailed out, because by bailing out AIG, you bailed out Goldman Sachs and other investment banks. And I have a different view from mainstream economists. I think the best would have been to let these institutions go bust, but then protect the policyholders in the case of AIG and the depositors in the case of banks. In other words, you ring fence the banks, and the other part that concerns the whole leverage transactions, the whole derivatives, that you let go. And that is then the problem of these institutions, because I don't see that the derivatives market fulfills an important function economically in the world. To some extent, yes. But as I mentioned to you, the banking system has a social function. So if you keep the banks in a conservative fashion, in other words, they accept deposits, and against those deposits, they extend loans, then I think that the deposit insurance may have some validity. But I don't think that the deposit insurance should be in place, because the bank goes and speculates with a leverage of 40-1. Well, basically, I think that one would have to be very careful with using quantitative easing and only apply it in very extreme situations, but not give a signal to the market that each time there is a problem, there'll be quantitative easing, because it's like giving to a patient antibiotics. Next time you give them, you need a larger doses, and the third time an even larger doses, and eventually the bugs, they get used to the antibiotics and there's no more reaction. And the big question is, if you inject money into the economy, as I pointed out earlier, if you drop the dollar bills into essentially the banking system, into the financial system, it may not flow to the working class, it may not flow to the lower middle class, it may not flow to the middle class at all. It may remain among a select few institutions, and by boosting asset prices, it may actually lead to higher wealth inequality. And so it's very problematic. Not long ago, Sheila Bair, who was at the time FDIC chairman, she proposed that a better way would be to lend each household $10 million interest rate free. I would say instead of lending $10 million each household interest rate free, you could also hand out a gift to every man, woman, and child in the US of $10 million. By doing that, you would create instantly an economic boom. Everybody would rush out and buy a car, go on holidays, buy consumer goods, frequent restaurants, go to the movies, and so forth and so on. But once the money is spent, what do you do then? First of all, when you do that, prices will go up somewhere. Irregularly, but they'll go up because there's too much demand for the existing capacities. And I suppose if other countries wouldn't do that gift of $10 million to each man, woman, and child, that the dollar would weaken substantially against other currencies. And there'd be inflationary pressures. But you could essentially do that all over the world and give to each citizen in the world $10 million. But you understand, you can't create prosperity by just handing out paper money. In 3 or 4 years' time, when that money will be spent and the system has adjusted through price increases to a new order, the next time you will not have to give the $10 million, you will have to give, say, $20 million. The next time, $50 million. And then you get into very high price increases and hyperinflation. This is the problem of overspending, whether it's on the private side by borrowing money or on the government side through fiscal deficits that increase the overall level of government debt. Well, basically, what happened is that the Fed was very successful at bringing down short-term rates, but longer-term rates stayed relatively to short-term rates at an elevated level. And through Operation Twist, they went in and bought government bonds, notes, the 10 years and the 30 years, and so they lowered interest rates on these instruments. But I'm not sure that this had a huge impact on economic activity. And it again distorts the marketplace, it creates misallocation of capital, and it allows the government to borrow money at essentially very low rates, which then increases the deficit even more. On the short end, basically, yes. The question is, will it be desirable to hold rates down if, say, for one or the other reason, consumer price inflation would pick up substantially? In my book, the consumer price increases around the world is, of course, larger than what governments are publishing. Say in the US, for the typical household, I think that the cost of living are rising at around 5 to 8% per annum. Some people think at an even higher rate. But say 5 to 8%, I think, would be a fair assessment if you count in healthcare costs, insurance premium costs, the increased contributions that you make to the government in form of indirect taxation, higher parking fees, higher fines, higher local taxes, and so forth and so on. So I think that we have actually already today artificially low interest rates that are again creating some misallocation of capital. I think they're pretty much the same. And by the way, we're coming into an election in November. I don't think there will be a huge difference whether Mr. Obama is elected or Mr. Romney. They're both going to continue to overspend. In other words, they're not going to cut spending dramatically. Under Romney, military spending will be higher, and under Mr. Obama, handouts will be larger, but the spending as a percent of GDP will stay at a very elevated level, and I doubt that they can increase taxation sufficiently. So my essential view is that the deficits of the government, the so-called fiscal deficit, will remain comfortably at above $1 trillion annually. That will increase the government debt very significantly over the next 10 years. Well, I think that one day, and I don't think it will happen right away because we have excess capacities in the system and we have essentially a global economy that is decelerating very rapidly. Europe is in recession. The Chinese economy is weakening significantly and so forth. So I don't think that interest rates will go up right away. But say down the road, in 3 years, 5 years or so, interest rates could go much higher than is perceived for a variety of reasons. One of them being obviously that if the economy stays weak, the fiscal deficit will rather increase, possibly to $2 trillion, possibly even more. And you have more and more government debt as a percent of the economy, and at some stage, as in the case of Greece, Spain, Portugal, Ireland, Iceland, and so forth, the quality of this government debt goes down, and people realize, yes, the US government will repay its debts and they will pay the interest on the debt because they can print money. But they will realize that this money that they are repaid in will have lost its purchasing power against assets and against, say, precious metals. So people will no longer trust to buy government notes, bonds, and bills. I think I explained before that if you drop dollar bills onto the United States, as Mr. Bernanke has written and indicated before, it doesn't need to create a bubble in the United States. I think if I had to bet that there is somewhere a bubble, there has been a bubble in emerging economies. There has been a bubble in the Chinese housing industry. There has been a bubble in growth in emerging economies. There has been a bubble in the Canadian dollar, in the US dollar, in the Swiss franc, and so forth. Some have begun to deflate, and so forth. And there is one bubble that I think is very obvious. There's a bubble in US government bonds and in the fiscal deficit. The fiscal deficit is out of hand, and rates on government bonds are artificially low, and this bubble will burst one day. But as I say, I don't know whether the 10 years note and the 30 years bonds, whether the interest on these instruments will start to increase dramatically in 1 year's time, in 6 months' time, in 5 years' time. But very clearly, one day they'll increase very substantially. Well, basically, at the present time, the view is this. Investors know that it's not a very desirable investment to buy treasury bills that have no yield. In some countries, they have even a negative yield, like in Switzerland, Germany. In other words, you buy an instrument and you get less after 6 months and after a year's time. But these people they argue, well, we're not so interested in losing just 0.5% or 1% per annum, but we want to avoid losing 30% per annum or losing everything. So a lot of money that was deposited in the interbank market doesn't trust the interbank market anymore. So that money flows. Let's say you're the treasurer of IBM, and you have substantial liquidity that you want to place, and you want to place it safely. You may not give it to a bank, but you may buy treasury bills, because maybe you lose 0.5%, maybe you don't lose anything, but at least it will be repaid to you. With the banks, you're not sure that it will be repaid to you. Yeah, I suppose it is a bubble. It's now over $1 trillion. I think that eventually there will be some debt forgiveness for students. But very clearly it has an impact on the lives of young people, in the sense that if someone has very large student debts, he may not be able to buy a house, and so he has to go and rent. And if he has to rent, by renting and not buying, he will push up the rents. And I have friends, they own apartment buildings, rentals, so-called rentals, and the rents have actually trended up. So, you know, again, there is a distortion there. And a lot of people go to college and they go to universities and they study things that are basically useless. And they will not earn a lot of money. And so they will have difficulties in repaying these student debts. And so, as I mentioned at the beginning, in my view, we have too much debt on the household sector level, on the students level, on the government's level. And during the debt expansion, 1980 to 2007, it boosted economic growth rates above the trend line. And now we are in a process that we are over-leveraged, and for the next 10 years or so, we will have very disappointing growth rates, and not just in the US, in particular also in Europe. I don't know how high they will go, but I think in an environment, and I talk occasionally to central bankers, their view is actually that the problem is that they didn't inject enough liquidity, and the views of the Keynesian like Mr. Krugman is that the fiscal deficits are far too small. You understand? One of the problems of the crisis is that it was caused by government intervention with fiscal and monetary measures. Now they tell us, well, we didn't intervene enough. Yeah, if they really believe that, they should go and live in North Korea, where you have a communist system. There the government intervenes into every aspect of the economy, and look at the economic performance of North Korea. Well, I think that because I travel extensively to Canada, in my view, Canadian home prices now are in a bubble stage, particularly in Vancouver and some of the resource-producing regions like Alberta and Saskatchewan, maybe in Toronto less. But I think if I look at Canada today and Canada 10 years ago, 10 years ago Canada was inexpensive, and today it's very expensive. It's much more expensive than the US. It's probably also a much nicer country than the US. But I think they have some bubble symptoms as well. Household debt as a percent of the economy is larger than in the United States as well as in Australia. So these are bubbles that you asked me before. These are bubbles that have developed. There was also a bubble in 2008 in commodity prices. Commodity prices went ballistic. And obviously since then they have declined quite substantially. Well, there are different views about China. I went to China, unlike some other people that turned very positive about China, who just been there for the last few years. I went the first time to China actually in 1981, and I went to the first time to a communist country in 1968, to the Czech Republic, at that time Czechoslovakia, and I've been to Russia already in 1980. So I'm actually quite familiar with communist countries. And when China began to open up in 1978 under Deng Xiaoping, when he introduced the open door policy, China was an extremely poor country. And even in 1990, China was still an extremely retarded country and extremely poor, with the exception, because when they opened up, the open door policy concerned essentially the Pearl River Delta, a narrow region around Hong Kong, and then this experiment was successful with the special economic zones of essentially Shenzhen notably, and Dongguan, and later on they had also Xiamen in Fuzhou province. Then that was then expanded to the whole country after 1990. And my view was, and I've written about this, my book, Tomorrow's Gold, Asia's Age of Discovery, was mostly about the rise of China and the impact of China on the commodities markets, and that they would drive commodity prices up because of the incremental demand that a country has for raw materials when it industrializes. So I'm actually quite familiar with China, and obviously I'm deeply impressed by the achievements over the last 30, 40 years. It's mind-boggling. But to believe that an economy never has any recession is, of course, a complete fallacy. Rapidly growing countries are characterized by big setbacks. And we had a big setback in China in 1994. The vacancy rate in office buildings in Shanghai went to close to 30%. So nobody can tell me that there won't be business cycles in China. The most successful economy ever was 19th century United States, 1800 to 1900. During that period of time, they had close to 20 economic and financial crises, close to 20. And yet the country grew, and they had a civil war. So in China, many things can happen. Doesn't change the fact that maybe long term it will be a very prosperous continent. It's not a country. The size of China is like, in terms of population, is like Europe and the United States times 2, twice as large. So we're dealing with provinces that are as large as France, others are as large as Italy, others are or will be as large as Germany. It's a huge continent, and I'm sure there will be plenty of opportunities. I'm just saying the Chinese economy, if you look at the present statistics, has been decelerating very rapidly, and in my view at the present time it is hardly growing. The statistics published by the government may not be very realistic. And I think there is the potential that the Chinese economy actually crashes, that you have even social problems. Possible. We can also have social problems in Europe and in the US. We can have it anywhere. Just to sit there and say everything will be fine, I think this is the wrong attitude. Everything can happen. And I would be very careful, because the Chinese economy on the margin has a much larger impact on raw material demand, on raw material pricing than, say, the US or Europe. If the US grows at 2-3% or contracts at 2-3%, has hardly any impact on the demand for copper, for iron ore, for steel, for nickel, aluminum, and so forth. If the Chinese economy grows at 10%, only 3%, makes a huge difference on the demand for these raw materials. And so I would be essentially very concerned if I felt, and I do feel that way, that the Chinese economy is decelerating. And by the way, commodity prices would not be as depressed as they are now and would not have performed as miserably since July 2008 if nothing was wrong with China. Well, they have already gone down substantially. This year, the US stock market made a new high. On April 2nd, the S&P was at 1422. It was above the high of May 2011. But all the commodity prices had essentially peaked a year ago, with exception of gold that still rose into September. So the commodity markets have performed miserably already. But I don't think they'll go up. I think actually the industrial commodities are still vulnerable. So if an individual wants to play the commodity markets, I would tell him, just buy physical gold or physical silver. Well, I think the US dollar will remain for the time being a reserve currency. But obviously, I'm ultra bearish about all paper monies. I think, as you know, the Federal Reserve was founded in 1913, and up to this date, the US dollar has essentially lost 97% of its purchasing power. I think paper money will continue to lose its purchasing power because it's the easiest way for governments to hide economic weakness and problems in the system is just to print money. And every government throughout history has done it. No paper currency has survived for long. For long, I mean, can be a few hundred years and so forth. But over time, they all became worthless. And that, I think, is the fate of the US dollar. And that's why I'm telling people, don't speculate in gold, but just keep some gold coins instead of keeping cash US dollars or cash euros or cash any paper currency. Because over time, you can print paper, but the supply of gold is relatively limited. And so I would think that paper currencies will continue to depreciate against precious metals in the long run. It does not mean that every year precious metal prices will go up, but I think in the long run they will go up, because if you really analyze the situation, we had a weak US dollar, but 2008 we had a strong US dollar because global liquidity tightened. We had at the same time a recession. So we have more money printing thereafter, then asset prices go up again, but the dollar weakens again. And during that period of time, the dollar weakened, gold and silver performed very well until, as I said, September 6th of last year, the gold price went to $1,921. Then it corrected to $1,522 on December 29th, 2011, and since then it's rallied again, it came off again, and now we're around the $1,600 level. But I think in general, when the dollar is strong, it is a symptom of tightening of global liquidity. In other words, the global economy shrinks. And after a certain while of shrinkage, there'll be money printing everywhere, in China and in America and in Europe and in Latin America and so forth. So I don't think that people should keep their savings necessarily in cash long term. Short term can be the case, but longer term you have no interest on your deposits, and essentially you have cost of living increases. Everything is becoming more and more expensive. So in real terms, inflation adjusted terms, if you look at say 10 years from now, If you put your money in dollars deposits and the interest rates don't go up, you will have no return. And the Fed has actually said they would like to keep interest rates below the rate of cost of living increase, below the rate of consumer price inflation. And so in real terms, inflation adjusted, you're going to lose money on cash and, by the way, also on government bonds. And so I think that investors should accumulate gold, not speculate in gold, but accumulate gold. Was concerned that Y2K would be a problem, so they flooded the system with liquidity. And the Nasdaq, which had been already very elevated in 1997, between August 99 and March 2000 doubled. And then we come to the collapse of the Nasdaq, and the Fed was concerned about the deflationary recession. And as it was the case with the tequila crisis, with LTCM, they again bailed out the system by flooding the system with liquidity and pushing the Fed fund rate down from 6.5% to 1%. And this led again to very rapid credit growth, because essentially financial institutions could borrow money at very low rates. And the problem is with excessive credit growth is that the credit growth can be controlled in theory by a central bank or even the Treasury, but it wasn't paid any attention to by the Fed. They slept under the influence of the Keynesian. They actually encourage credit growth. And when you create credit and when you expand the quantity of money, you know how much you want to expand it, but you don't know where the credit flows will go to. So essentially, in the words of Mr. Bernanke, you drop the dollar bills onto the United States, but he doesn't know where the money will flow to. So it flowed, as I just mentioned, first into Nasdaq in the years 97 to March 2000. Because as I just mentioned, when you print money and you drop your dollar bills onto the United States, they can flow into Nasdaq stocks, they can flow into the housing market, they can flow into collectibles, they can flow into stocks, they can also flow outside the United States because we have leakages. In other words, you print money in the US, but you boost economic growth rates and inflation in Vietnam, in China, in India, in Brazil, and so forth. So that the Fed does not control. And this is the viciousness of money printing, that it lifts prices, but irregularly. Sometimes inflation will flow into consumer prices, sometimes into asset prices, real estate, equities, bonds, foreign currencies, say the Australian dollar, the Canadian dollar, and so forth and so on. And that has essentially happened. Well, they played a very significant part in distorting the market, because these government-sponsored enterprises were able to borrow money at essentially almost the same rate as the government was able to borrow, because they were perceived to be guaranteed by the government. In addition to that, they were very badly run, because they were government institutions basically, and also highly corrupt institutions. And 30%, by 2000, he could refinance his home with essentially no collateral. In fact, there was a lot of fraud where a house had appreciated from $100,000 to $200,000. It was then refinanced with a mortgage of $220,000 or even $300,000. So there was to start with no collateral. There was just the expectation that the house would continue to appreciate. And eventually the housing market came apart because of oversupply. and lack of affordability, and then the whole credit bubble that was focused on the housing industry unraveled. The system didn't know for sure that they would always be bailed out. But with the bailout of LTCM and again with the essentially bailout of the economy after 2000 when the Nasdaq sank, the system began to get used to a so-called Greenspan put. And when Mr. Bernanke became Fed chairman in 2006, the saying was, there is a Bernanke put with a higher striking price. In other words, the expectations were that if anything happened to the system, the Fed would come in and flood the system with liquidity, which indeed they did actually after 2008, but it didn't help the housing market. And after 2000, it flowed into the housing market. And credit conditions were made easier and easier, and at the same time, the Fed encouraged subprime lending. They felt that this was a very good thing, that even people without money could buy homes. And so we have a lowering of credit standards in the housing industry, and then came the whole securitization process, and it created a gigantic housing bubble which the Fed couldn't identify, because they felt in 2007 that maybe there would be a slowdown in the rate of appreciation of homes, but they never thought that they would go down. And the people had been brainwashed by economists and the Fed and so forth that home prices in the US had never ever gone down, which is maybe true for the entire United States, but they had gone down very significantly in California after 1990. But that nationwide home prices would go down, that was foreign to the Federal Reserve, with all their economists that went to very prestigious business schools. In any event, this then happened because there was too much credit supporting the housing market, and home prices had gone up to an extent that affordability had diminished. And as I just mentioned, the credit standards were no longer existent. In other words, whereas 10 years ago someone may have bought a house and paid down 20 or Well, I think that if we analyze the causes of the housing bust, we have to go back a long time. In fact, actually to the 1980s, when credit began to grow at a faster pace than the economy, and debt to GDP expanded very rapidly. And what we then had is in 1990 an SNL crisis, and basically the system was bailed out at that time. And then we had in 94 the tequila crisis, and again the system was bailed out, largely because at that time Goldman Sachs and some banks and investors held large positions in Mexican bonds. So the Treasury, against the advice and against the will of Congress, bailed out Mexico essentially to protect financial interests. And then we get to 1998 and we have the LTCM crisis. LTCM would have gone bust, but again LTCM was bailed out by the Fed and the Treasury. And it was again to protect the financial system. And then we come to the late 1990s. We had a housing bubble. We had in the late 1990s a tech bubble. And the head of Y2K, the Fed was